Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode number 235, How to Find Planning Opportunities on Your Tax Return. All right, Joe, welcome back to the show.
Good morning, Cory. Yeah, it's good to be back.
Thanks for joining me on Upticks this week. And for those who are watching and listening at home, you will notice that Jake is not with us here this week. I'm pinch hitting for Jake as he is traveling back to Kansas City from Texas. So excited to talk about today's show. Joe, I appreciate you being here. And again, thank you to all of the subscribers. We've been encouraged to see that the subscriber counts on YouTube. We're continuing to get more reviews. We're seeing the subscriber counts grow, and we've been getting a lot of positive feedback from the show that we're doing, where we really aim to enhance people's financial literacy and explain what their financial plan means to them. A big part of what we do at Falcon Wealth Advisors. And again, today, what we're going to talk about is planning opportunities around your tax return. But before we get into all that, Joe, again, appreciate you coming back on the show this week. I feel like it's been a little while. What is new with you, Joe? What's been going on in your life?
Good question. Maybe the biggest thing at the moment is last month, my wife and I bought our first house, which is very exciting. And we really made it painful because this house is quite the fixer-upper. It's in a really neat part of town. It's a really neat old historic home, but it needs quite a bit of work. And if you're watching on YouTube, today's Ash Wednesday, and I'm sporting my ashes, but this very well could be the dust from all the work that I do on the house after work. But so yeah, it's some effort. It's a little messy at times, but I'm excited. It's fun. It's an adventure, and one way or another, it'll go really well. And we might take on another project in the future, or it may not go well, and we decide that this isn't for us. But either way, it'll be a learning experience, and I'm excited for that.
There's only one way to find out. That's great, Joe. And again, we're all happy for you. And I'm glad that what you have on your forehead today is ashes, and it's not dust from work that you were doing at the house early in the morning with your suit on before work. But very good. We're excited for you. And one quick side note to point out, one thing, Joe, that you and I looked at recently, and this is something that I think is interesting for people who are watching and listening at home. We have found on the Kansas City Public Library, there's an archive. Interestingly, that back in 1940, there was an initiative, for the lack of a better term, to photograph every standing structure in Kansas City. So homes, buildings, et cetera, every standing structure. And there's a really neat archive out there. A lot of buildings that were captured as part of that would have never been captured otherwise. Buildings that have basically been built and torn down in that same time frame. But Joe, with you and Killian buying an older home, and Cassie and I, of course, living in an older home in Kansas City, Missouri as well, we were able to find both houses on the archive and see what it looked like back in 1940. And obviously we know what it looks like today. Yeah.
And the crazy thing that it hasn't changed that much. It's almost exactly the way it was, which is sometimes a problem, but it's also pretty neat that these homes still have some of their original charm.
Absolutely. And the trees are a lot taller. So very good. Very good. Well, thank you again, Joe, for being here. Let's just go ahead and get right into it. And what we're talking about today is how to find planning opportunities on your tax return. One of the more common questions that we get from clients is, how do I pay less money in taxes? Which there's a whole lot of different ways to answer that. But what our intent to highlight on the show here today is, as part of our signature plan process with our clients at Falcon Wealth Advisors, a big part of what we're doing alongside financial planning is also proactive tax planning. And we wanted to highlight today really how to go about doing this, when to go about doing it, and what to really look for. So just to get us kicked off here, Joe, to begin with, how do we go about tax planning for our clients? Can you talk some about Holistiplan that we've been using for a few years now?
Yeah, it's great. So we've, of course, done tax planning prior to Holistiplan. But the beauty with Holistiplan is we get much greater clarity around the details of someone's tax situation because the numbers come straight from the tax return itself. previously we've had to, ballpark things and have to talk through projections and estimates. But now that we have access to clients' tax returns, there's just a lot more clarity, which is great. One thing I would highlight for Holistic Plan right now is as clients are filing these returns in 2022, or sorry, in spring of 2023, but for tax year 2022, one of the things that we would encourage you to do is, while this is top of mind and you're going through the process, to send those tax returns to us. We'll at least keep them on file, maybe do some initial planning if it's relevant, but primarily the heavy lifting of this tax planning will probably occur in Q4 this year, just when 2023 is most of the way over. Again, we'll have even more clarity into what the year has looked like. But Holistic Plan is great because, again, it allows us to do some projections for future years. It gives us clarity into what happened in previous years. And honestly, the Form 1040 is just not a very easy thing to look at. So Holistic Plan can do a really good job of simplifying things, highlighting key figures, things of that nature.
And Joe, I think that people who watch or listen to the show regularly may have some familiarity with this, but I should have mentioned this from the beginning. Can you just explain what Holistic Plan is?
Sure. Holistic Plan is a tax planning software that we can use as advisors and planners to really do two things. The first is we can take a client's tax return, scan it into the software, and the software will generate a report. This report will do a couple of things. One is to summarize what happened last year, but also to point out some potential planning opportunities. We can talk through, what those might be like, but based on some metrics that Holistic Plan looks at, it might suggest a Roth conversion, or it might suggest realizing some capital gains or losses. So we can scan in the return, it can give us a report, but also it can help us model future tax years. So in tax planning, we can't go back in time, obviously, that's done, but we can use a current year to project what a future year might look like. And one neat example of this is, as the law changes, Holistic Plan can actually model what the impact to someone's tax situation might be, whether or not those tax changes occur and how significant those tax changes are. So to summarize, we can generate reports and give people summaries of prior tax years, but we can also project and model what future years look like. So really helpful tool, really easy to use, and it streamlines the process so that we can do this across the board.
Very good. And, Joe, obviously with you being a CPA or a recovering accountant, as I've liked to joke with you with, or joke with you about, Joe, can you just, with you and the financial planning team, I know that you guys have really kind of led the charge in a lot of the tax planning discussions that we've had with clients and running these reports. I'm just curious, Joe, can you kind of give everyone an idea of where you have found this to be most useful for people?
Yeah, it's great. I would say two things in particular. The first is more short term. When clients have questions about whether I should do pre-tax or Roth, or whether at the end of the year we're trying to determine what amount of a Roth conversion we should do, there's usually a very specific question and it requires a very specific answer. So in a short-term annual basis, Holistic Plan can give us really specific insights into saying, we think this is a good number. These are recommendations that we can, hold out there for you to take to your CPA. So I think in a short time frame, it can be pretty specific, but maybe more importantly, we can extrapolate some of the information in the short term and use that in accord with your financial plan, which looks, 10, 20, 30 plus years down the road, so that we can put into context what are the things we're doing in a specific tax year and what impact does that have on the long term. And of course, for us as primarily financial planners and not just tax planners, that's really our big goal. So we're looking at people's tax situations over the next 2 or 3 decades. So some of the decisions from what we do in a single year comes from the perspective of how can we minimize and plan well from a tax perspective over the long run.
Very good. I think that's useful for people to understand. It's just not, none of it's done in a vacuum. The same way that we like to meet with clients regularly to talk about their financial plans and what's changed in their lives. The idea here is we want to do the same thing in evaluating the tax situation, because situations for people change from year to year. The tax code can change from year to year. And there are, steps that people can take today that may have far more of an impact down the road, that if they're not being proactive in looking at this tax analysis and how that fits into their financial plan, we can miss it. So we've been very pleased using the software. I've gotten a lot of positive feedback from clients, but I want to get into some of the specifics, Joe, around this software. So again, we can scan in a client's tax return, pulls all the information, gives us a nice summary. I'm curious, Joe, as a CPA yourself, and I should point out for everybody watching and listening at home, everything that we're talking about here today is intended to be a discussion around tax planning. We're not intending to give anyone specific tax advice. We do not intend to replace anyone's accountant. The idea is the proactive tax planning that we do is intended to be in conjunction with your financial planning, along with the relationship that you have with your tax advisor. But with that being said, Joe, I'm curious, if I sent you my tax return and you scanned it through today and looked at it, what specifically are you looking for?
Yeah, the number one item on a tax return, and this isn't going to be a huge surprise, but the number one thing that we're looking for is taxable income. There are different ways to slice and dice that. There's adjusted gross income and modified adjusted gross income, but I'll speak generally here and just say that someone's taxable income in a given year is really key, because that number will determine many other things. As we all know, there are general rules and exceptions to the exceptions, and the tax code is very complicated. And these all these rules and opportunities have thresholds, and they usually are operated around someone's taxable income. So once we have that number, or at least a good idea of what that number might be, it opens the door into what opportunities are relevant, which ones are not, and whether we should be optimizing you lowering your income, or in some situations we might want to optimize increasing it depending on someone's situation. So that number, what is someone's taxable income, and maybe at a high level, I'll just say someone's total income, all the money that they make, less any relevant adjustments and deductions. That number is really crucial, because it's usually the driver in most of the planning opportunities that we work with.
Very good. So total taxable income. And again, there's lots of ways to slice and dice it, like you said, Joe. But once we have that figure, once we know what that looks like for someone, and we're evaluating their tax return and thinking about the future planning for them, I'm curious from your perspective, Joe, what's the simplest way that you would explain to someone what their tax bracket is? I know that's a big question, but what tax bracket am I in? And just explaining the difference between someone's marginal rate and their average rate.
Yeah, this is fundamental and basic, and we've probably talked about this before, but I really think that this is helpful in just giving people some context around this whole tax conversation. So first, it's helpful to know that our current tax rate system is bracketed. It's in tiers, and they are progressive. So the more money, obviously, that you make, the higher percentage that you pay on those dollars. We often talk about tax brackets, and as an example, after the 12% bracket is the 22%, but it's important to remember that when you go from the 12 to the 22, it doesn't mean that all of your dollars are now taxed at 22%. I'll use round numbers for illustrative purposes, but the first $10,000 might be taxed at 10%. The next 50 might be taxed at 12, and then the next 100 might be taxed at 22. But it's important to remember that only the dollars that fall into that specific bracket get taxed at that rate. And this is where the term marginal tax bracket comes from. The best way to think about it is a marginal tax rate is the tax rate associated with each additional new dollar. So if you're currently in the 22% and you have runway in that bracket, your marginal tax rate, the rate on new dollars, will be 22%. Now, it's a little bit more complicated than that because we have to be specific with which kind of bracket we're talking about. There's ordinary income and there's capital gains. But generally speaking, it's helpful to understand that it's the tax you pay on each additional or marginal dollar. That's helpful because it essentially answers two questions. The first might be, what tax am I going to pay on each additional dollar that I make? Or if I'm able to reduce my taxable income, what's the tax rate that I'm saving myself from? So if you're in a really high bracket, a high marginal bracket, it becomes much more important to reduce taxable income because you're saving yourself from that high marginal bracket. This is in contrast to two different terms. They have a slight distinction. One is average tax rate, and the other is effective tax rate. The small distinction between the two is whether you are talking about your total income or total income after deductions. But that point aside, the thing to highlight here is marginal tax brackets or tax rates refer to the different brackets or the tiers. And sometimes you might be in the 22%, and that number sounds high. However, if you consider the other lower brackets and you look at what is the average tax rate that I paid across all of my dollars, you can find that by taking total taxes paid divided by total income, and you'll get a lower number than your marginal rate. It might be something like 10 or 12% if the majority of your income is taxed at that 10 or 12% bracket. So that's a helpful metric because with all of the deductions and adjustments that go into calculating someone's income, you don't just pay the highest rate, you pay a blended rate of sorts. So sometimes average or effective tax rate is a better indicator of exactly how your tax year went, because if you have just $1 in the 22% bracket, yes, your marginal bracket is 22, but the reality is that most of your dollars were taxed at 10 and 12%. So I think that's just good perspective to kind of conceptualize the whole tax rate and the whole tax bracket system.
Very good. That was a great explanation, Joe. And I think just to add some context to it, or to just give a real life example, just yesterday I was meeting and reviewing with a client. We ran this tax report for calendar year 2021, actually, and we were looking at the results of that. And we highlighted exactly what you just described, Joe. This particular client is in the 22% marginal tax bracket. However, based upon all of the taxes that they actually paid in that calendar year, their average rate was just shy of 11%. It was like 10.8. So the point there being, you may be in a higher marginal bracket, but that does not mean that you are paying that percentage on all of your income.
Exactly.
And I think that's especially important for people, the effective rate or the average rate, I think is really important for people in retirement. I think it's important for people all the time, but it's particularly important for people in retirement, and really the way that we're looking at and mapping out someone's financial plan. Because just because someone's in the 22% tax bracket doesn't mean that, again, that's how much tax they're going to pay on every dollar that they earn. And this is really crucial when it comes to tax withholding, which is another item that we will look at when we're evaluating someone's return in the context of whether there is a refund from the IRS or if there is a liability owed. Joe, can you just talk some more about the importance of tax withholding and opportunities that can exist there for clients?
Yeah, great. So let's use clients that are retired as an example first. And let's say we're sending them distributions from their IRA. As a reminder, when you take funds from an IRA, it is counted as ordinary income. And if you don't withhold any taxes, come tax time the following spring, you may be surprised that you will be owing lots of taxes and will likely have a penalty. So withholding on IRA distributions is just as relevant as tax withholding on your W-2 when you're employed and you have a salary. A few key things to remember about tax withholding. The first is that the IRS rule is it's pay as you go. So sometimes this is overlooked, but the IRS doesn't want you to make a bunch of money in January, not pay any taxes, and then nearly 12 months later do the withholding for that income. because if we conceptualize what taxes are, they are the revenue stream of sorts of the government, and they want to be able to fund their operations when as soon as possible. So the rule is, as the money is earned, that is when the tax withholding is relevant. A good example of that is quarterly estimated payments. If you are in a particular situation where you don't have withholding from a paycheck or from IRA distributions, you might have to make quarterly estimated payments. It's not allowed to simply push the first, second, and third quarter to the fourth. You have to pay as you go. So I think that's one helpful reminder. The other, though, is it's often the case that when folks get a large refund come April, they might be particularly excited and think of it as free money of sorts. But we have to remember that that just simply means that you have given the government more than you should have. And when we think about folks' financial plans, it's important for us to have as much money working in their portfolios as possible. So we don't want to take out more money than we have to, give an interest-free loan to the government only to get it back in 12 months. We want to be as accurate as possible. Of course, we don't want you to be stressed and worried about having to owe money come tax time, but we want to keep as much money in your portfolio as possible, keep it working for you. We don't want to have interest-free loans for the government, and we want to try to pinpoint so that at the end of the tax year, your tax refund and liability are both relatively small. If you find that it's outside of a reasonable margin, it might be helpful for us to reevaluate maybe what that tax withholding is, and we can work with your CPA to maybe get a specific recommendation.
Very good, Joe. Thank you. And I think that that's a really good way to describe it all. And I think for someone who's watching or listening at home, I frankly think that some people almost use the IRS as a forced savings mechanism. Perhaps if people just struggle to save more money more frequently, they will effectively use tax withholding as a bonus, for the lack of a better term, that comes back to them when they file their return. But again, it's really important for people to remember that it's ultimately your money. And I think in the context of someone's financial plan, especially if someone's already retired, if they're pulling $50,000 per year out of their retirement account, but they're getting $5,000 back at tax time every year when they file their return, and they go and spend that $5,000, what that really means is that someone's spending $55,000 a year, not $50,000 a year. And that's important for people to understand too, not only because of the impact on their taxes, but also the impact on their long-term financial plan, to help people understand what it is that they're actually spending, as far as what comes out of their accounts and what's withheld for taxes.
Yeah, great. Maybe one additional point, this is kind of odd to say, but let's take an IRA, for example. Mm-hmm. If we take money out of an IRA for tax withholding, so we send those funds to the state and federal government, we actually pay taxes on the funds that we withdraw for paying taxes. So of course, we want to minimize that if possible. We don't want to pay taxes on dollars that were used for paying taxes if it's not necessary.
Yep, that's really good. That's great, Joe. I appreciate that. And I appreciate you explaining that, because I think that's useful for people to understand, especially as they're just trying to get that tax withholding right in terms of what's going to work for their plan now and also in the future. But of course, we want to be flexible to the fact that it may need to change as circumstances and as life happens and things change. A few other points that I just wanted to bring up here, Joe, that I know that you and I have looked at when we've evaluated these reports for clients around planning opportunities. And that would be something that is called the net investment income tax, and also IRMA, which is income related monthly adjusted amounts as far as Medicare premiums go. Can you just talk briefly, Joe, about those two pieces and what the opportunities can look like there?
Yes. So we've primarily talked about ordinary income brackets and ordinary income tax rates. Another very relevant tax rate and tax bracket for us is the capital gains tax rate. The ordinary one that refers to normal income has many brackets, 10, 12, 22, 24, so on and so forth. The capital gain is a little bit more simple. It is 0% in the lowest bracket, 15 for most people, and then 20% at the high end. Generally speaking, that's preferential. It's more advantageous than the ordinary income brackets. However, one thing that can sometimes be included in this, if you're not paying attention, is net investment income tax. So there's an additional 3.8% that may become relevant if the income is too high. One thing that's really helpful about Holistic Plan is when we evaluate clients' tax situations, Holistic Plan gives us all of the relevant numbers and all of the relevant brackets to be thinking about. So we might say we'd like to add, $50,000 of income for a Roth conversion because we're comfortable with the ordinary income bracket that will keep us in. However, Holistic Plan will remind us that if we do this potentially, it may trigger an additional 3.8% investment income tax. So it's important for us to not have any blinders or blind spots. And Holistic Plan does a really good job of that, so that when we increase income, we're not just looking at one bracket, we're looking at everything. And certainly capital gains and the net investment income tax is a good example of that. One note on the IRMA, as you mentioned, that's another good example of something that maybe isn't top of mind for most folks when they're doing tax planning. And that is because, again, we're primarily looking at ordinary income brackets. Maybe we're looking at capital gains brackets as well. But, an even further element to consider is what impact does this have on a client's Medicare premiums? So maybe we're comfortable with, staying in the 22% bracket. But if we do a $20,000 Roth conversion, we're going to increase someone's Medicare premiums. But if we only do 10, then we won't. So it's just like another great example of things that some people don't always think about, but it's certainly relevant. We don't want to just be focused on one aspect. We want to be as comprehensive as possible. Holistic Plan really helps us do that. And those two examples, I think, really highlight the necessity to think about more than just what's my marginal tax bracket.
Very good, Joe. Thank you for that explanation. I think that is a helpful way to highlight it. I think this can be useful for someone who's retired and taking distributions from retirement accounts. Even if someone's just contemplating, should I take that extra distribution this calendar year? Maybe it's in the fourth quarter, or should I wait till the next year? What's the impact going to be on my Medicare premiums and everything else involved? Because I've heard enough stories from clients or friends of clients who have said, my neighbor's cousin's husband took a big IRA distribution to pay off some liability and didn't understand the impact that would have as far as their Medicare premiums go, and how long that impact can last, which can be for 2 years or more. So all useful information. Again, I think we've highlighted a lot here today for everyone who is watching and listening at home. But Joe, I think that the primary takeaway from today's show is that there's a lot of opportunities for tax planning that coincide with financial planning. This is the time of year when people are filing their returns for us to gather those 2022 tax returns so we can run them through the software and we can evaluate very specific opportunities for clients as the year continues on. As we get closer to the fourth quarter, we understand what the situation looks like. But this is the time for us to really begin gathering that information and running those returns through our software so we can have productive and effective conversations around tax planning a few short months from now, because we know before we know it, it'll be the third quarter, it'll be the fourth quarter, it'll be the holiday season all over again. It certainly seems like that's the way that time is flying by. But Joe, do you have any final thoughts or parting words here?
Yes. Last thing I'll say, and I think you briefly touched on this, in that tracking and gathering this information really is the first step. In the analogy of, you can't really have a budget until you first track what it is you're actually spending. From a tax planning perspective, the first step is really just to look into these tax returns. We can provide the summaries to you. We have to first understand what the current situation is before we can actually do any planning. So I think, first things first, let's just get on the same page about what the current reality is, and then we can start to make progress on how to optimize, how to plan, and how to take advantage of opportunities.
Excellent. Very good, Joe. Again, got to start somewhere. And that's exactly what we're talking about here today. So again, I appreciate your time today, Joe. Thank you for everybody who's watching and listening at home. As a quick reminder, please make sure you're subscribed to the show if you haven't done so already. That way you'll never miss any new episodes as they become available. Of course, give us the thumbs up or the 5 stars if you think the show and the content is worthy of that. We appreciate you tuning in, and we look forward to talking with you next week. Thanks again, Joe. Take care.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.